love the channel and find it useful in becoming a happy retiree. Subscribe today. The beginning of the summer market season, full steam ahead, second half 2017, and the markets just keep chugging forward. For the week, another grind higher. Just this grind higher, and no enthusiasm whatsoever about it. So there's this lack of enthusiasm. We've seen it all year, and most of the market, we've seen this for most of the last 8 years. We've had a solid market, bull market for the last 8 years, and it's just unloved. Nobody likes it. So the grind higher just this past week added another 1% to the Dow. It's a big number. An almost $20 trillion mechanism. Another 1% for the Dow this week, up 1.4% for the S&P 500, 2.6% for the NASDAQ. So fascinating to me this week. First of all, this outburst from one James Dimon. He runs JPMorgan Chase. He's the CEO, Jamie Dimon, CEO, JPMorgan Chase, on an analyst call, and he just blasted, and he wasn't mad at the question. He's just frustrated with Washington. So he had just an outburst, which is fairly uncharacteristic for a CEO on an earnings call about Washington and gridlock. And it's a theme that you've seen a bunch in the last year, and we certainly saw it this week. There's also, fascinating this week, a partisan conflict index. It's a statistical measure of the disjointedness or the gridlock that we see in Washington, and the fact that we still haven't been able to get anything done here in this administration. It's frustrating to those all around, and it's measured, and it's actually a measure, an index kept by the Philadelphia Federal Reserve. Number 3, fascinating this week, Janet Yellen. Janet, let's call her Goldilocks Yellen, strikes again. And again, a big reason for the market push higher. And then just this continued argument that we're going to have of passive investing versus active investing, new light shed on that. I've written about this in the last couple of weeks. A Wall Street luminary named Burton Malkiel, who is someone that actually for years, he was the author of A Random Walk Down Wall Street. And for years, this is a guy that promoted passive investing, and now all of a sudden he's changing his tune. So he's stopped singing the praises of just putting money, sitting it in a passive index fund for most of your life. Interesting that someone at his stage in his 80s would change heart. Part of this has to do with a concept, I think, it's a concept I'm calling peak passive, meaning that it's just, there has been so much flow into passive strategies and ETFs in the last couple of years. It's accelerated to the point where it almost looks like a bubble. And the bubble isn't necessarily in a particular sector, and the bubble isn't in a particular stock I'm talking about here today. I'm talking about this philosophy that you can just dump all your money into an index and just let it ride. And that's just not a realistic strategy for most investors. It can work if you're Rip Van Winkle and you literally invest one day, wake up 50 years later. As long as the world is a better place, you're probably going to have done just fine. But that's not how it works in the real world. We are alive, we're living, we're breathing, we are taking in more information today than we've ever taken in the history of the planet. So it's very difficult to just ignore the world and cut through all the noise, which is exactly what being a passive investor fully entails. So it's not a realistic strategy for most human beings that are emotional, psychological creatures. And the news flow on it in the last year or two, and we've talked a lot about this over the past year, I think it's gotten to the point of an apex where the pendulum may very well be starting to swing in another direction or the other way. Part of that has to do, and I don't know if this is a trend that's been happening this year. Over half of all large cap mutual fund managers have outperformed their indexes this year over the first half of 2017. So a good 54% of managers have done better than their benchmark, despite all of this money going into passive index funds. And there's a lot on this topic, And just the sheer mechanics of index investing have just become almost, to me, where they don't make sense or they're unsustainable. And here's an example of that. Let's go back to the early 90s when there were literally just a handful. There were about a dozen indexes that ETFs would track. From 2010 to 2012, the number of indexes quadrupled. So it got up to about 100, 250 as it continued on in the 90s and the 2000s. And then from 2010 to 2012, the number of indexes, not just stocks, the number of indexes got to 1,000. So 1,000 different indexes to track. Meanwhile, the number of stocks continuing to decline. So the number of stocks was about 7,500 if you go back into the late 1980s or mid 1990s. And then that's fallen over 40%. So now we're closer to 4,000 stocks. But here's how many indexes we have. We now have almost 6,000 indexes. So how can that reconcile? And if you let's just chart those two things out. You see indexes skyrocket, the number of stocks plummet. Now there are more indexes out there than there are individual companies to even buy. And that has to do with the proliferation of ETFs. There's nothing wrong with ETFs, but the fact that now there are more baskets of stocks than there are individual stocks to begin with is a sign that we have hit an apex in this whole philosophy of purely passive investing. So we go back to all of this angst that is happening, particularly with politics here in America. The Outburst this week by Jamie Dimon, CEO of JPMorgan. He's on an analyst call, and the analyst asked him about policy or tax reform, and he went they were discussing something that he thought was trivial. They had asked something about trading, and he said, who cares about trading in July? It's more unpredictable than the weather. What we should be talking about is politics, healthcare. We don't have a budget. We can't get tax reform done. We can't get repatriation of foreign assets here in America. And it's not just about big corporations. It's about getting these policies through that ultimately help every American. It's not just about helping companies in America. Let's just talk here for a moment about what I think is just eating up the country, and that has to do with this partisan conflict. Jamie Dimon, CEO of JPMorgan this week, just went on a tirade on an analyst call about the gridlock that he sees in Washington. And he's a CEO it sounds a little bit like a guy starting to position himself to run for office one day, but I just really doubt it. I really doubt this is a guy that would do that. I think he's just a CEO that's frustrated at the pace of business in America. And said that, look, this place has become a place of great bureaucracy and regulation and gridlock. And it's kind of frustration we've seen with voters and expressed here in the United States, in the EU, and around the world. We've seen it all over the place with Brexit. We've seen it here in America with the election of Trump. We've seen it in the Philippines, for God's sake. We've seen it in France. And there has become this movement that's anti-establishment because people are frustrated with government. It has to do with economic growth or the lack thereof. 1965 to 2008, that's for over 50 years, the U.S. grew at 3.1% per year on average. Since then, since the recession, which hit the entire world, we've only been growing at about 1.9 to 2%. That's a major issue. It's cost us $2.6 trillion. I want to also talk about this Janet Yellen, which really spurred the market this week. Again, another net positive week for the markets. This is we keep calling this an unloved bull market. Up about 1% for the Dow in the week, up 1.4% for the S&P 500, 2.6% for the NASDAQ. And we're at this point where the markets just continue to grind higher, and accompanied by just complete lack of enthusiasm. It's the same lack of enthusiasm we've seen all year, which is really not a bad thing. It's a lack of exuberance, which is a positive to me. And we're what I want to talk about here with Yellen. I'm calling Janet Yellen Goldilocks Yellen, And she strikes again, because this is the term, this Goldilocks term I've used now for several years. And in an economic state, it's about this uniquely balanced economy with data in a number of ways. So first, not falling completely or teetering on a recession, but also not revving the economic engine at 7,000 RPMs. It's, quote, just right. That's what Goldilocks really means for the economy. In an economy that we've been living in, so this is the economy we've been living in, it's not, quote, just right in terms of the perfect economy. It hasn't been gangbusters. It hasn't been fruitful for everybody. But Goldilocks means it's just right to maintain this low level of growth. And we've talked about this today. Part of the problem in Washington, or politically, is that we've had growth, but not enough growth. And it's a frustrating place to be. But it allows the Federal Reserve to be patient. Remember, an antsy Fed can pull the rug right out of an otherwise decent economic environment. If they raise interest rates too quickly, then borrowing rates skyrocket and that chokes off economic activity. If they do too much easy money, aka ultra low interest rates forever, then they create bubbles that eventually pop. So the Fed has to be threading the needle on very gradual rate rises. And this week, Janet Yellen continued to walk that tightrope without disaster. So she reiterated this week, again, that the interest rate environment, the hikes that we've been seeing, not a lot of them, but a few, they're going to stay gradual. And as soon as she said that, markets went off to the races again, up another 1%. So the economic data continues to drive this Goldilocks sentiment. So inflation data this week, not enough to scare us about deflation, but still below the Fed's target of 2%. And retail sales dropped 0.2%, not great, but still up 2.8% year over year. That's the same story we've been living with. Inflation, warm. Economy, warm. And not hot, not cold, just right there, Goldilocks in the middle. And the Fed tailwind continues. So instead of rates going up this September, probably won't happen now, probably not until December before we see rates go up again. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.